There we go. We are recorded. So yeah. So what's happened this week has been going on for forever. And one of the more well-known examples of this, and it might not be well-known unless you really follow the market closely, but there's two hedge fund managers. One is Carl Icahn, which you probably have heard of, and the other guy is Bill Ackman. One of the guys, I think Bill Ackman was shorting the stock. Herbalife was the company, and Carl Icahn was bullish on it. And the two of them were going back and forth. They were interviewed, I think it was on CNBC, and they had a 2-hour interview where they were just like fighting each other. It got pretty ugly, but I mean, they were short squeezing each other. It happens all the time, and it's illegal. So the fact that Robinhood and TD Ameritrade and Interactive Brokers and all the, I think Webull or Webble, I still don't know how to pronounce it. The fact that they're shutting down the platforms for average investors like us because we beat them at their own game, it's complete bullshit. And pardon my language, but that's what it is.
Yeah.
There's nothing that we did, and I say we being average investors, I didn't do the trade. There's nothing that any of us did that was out of line, illegal, or anything like that. We have every right to buy the stock. If we see people are shorting it, we want to buy it. Well, how's that not allowed?
So I know.
It is.
It's just like unbelievable. And do you know what they were doing as well? For example, if you had a stop loss, because it happens to me, because I've been on AMC since last week, and I bought because initially I only bought because they got bailout from the government, and it was like it might go up. Like I had like a price tag of $5, and I bought like under $3 a share. And then I bought last week, but obviously I wasn't expecting any of those things happen.
Yeah.
So, and then I woke up, obviously, well, I think everything started for MSC Wednesday. On Tuesday, it went like up like 30%, but it didn't hit my price target at $5. So I was like, okay, I'm just gonna wait. And then I woke up on Wednesday and I was up like 250%. I was like, oh my God, what is going on here? Yep. And then obviously, because I follow this guy on Reddit, and I also am on a Discord group with this guy.
Who is it? Is it Wall Street Bets?
Yes, Wall Street Bets, and there is another one which is quite offensive, like his name is something, F word, I follow this guy, and actually this guy is the one who started, but he started against Citron. The other guy on the Citron guy, which is like on Twitter, because he said he was shorting GM since he was shorting GM to $18. But I wasn't in GM, but I bought GM back in December and I sold last week. But I sold because I already reached my target, but I didn't know this would like blow like it. Otherwise, I would be like really happy right now.
Yeah.
So what they did is, obviously because I trade on volume and breakout. So, when like unusual volume, I'm paying attention to that, and then usually what I do, I buy a little bit and then, I can always scale in or out to depend on how it goes.
Yeah. And when you say you trade on volume, are you trading options or just buying the stock?
No, I'm buying the stock. I'm buying like on cash. I'm not trading option because obviously I don't trade on margin. I don't trade option because that is very risky for me at the moment. Because I don't understand very well, so I don't want to risk it. Because it's you can go both ways, right? You can get lots of money, you can lose lots of money. So I prefer, like steady and, not risk too much money. But I bought this stock, I bought the shares. So GME, it hit my target. So I bought under $20 and I sold almost like at $40. So that I sold it last week. So I sold like, I think it was like 88% return. So I was like, yeah, I'm happy with that. So,
that's
like,
pretty good.
I said, I'm happy with that. And then I bought AMC with price tag $5. So I bought under $3, price tag $5. So yeah, okay, let's see. And then
well past $5.
Yeah. And then obviously, you know, like on Wednesday when I wake up, it was just crazy. It was like $17, you know, like, and then it hit like $25. I was like, oh my God.
Yeah. Did you cash
um,
out at that point?
no. So what I did was, and then obviously because I followed this guy, you know, Reddit, and I'm on the Discord group and everything. So yeah, then it was like, oh yeah, this is also a short squeeze. And you know, but the real short squeeze is GME because you know they had like over I think 140% over the shares available to trade. So that the short, you know, is incredible. But AMC is only I think 40%, so it's nothing compared to GME. But I was like, okay, you know, this guy might keep bumping this stock, so I'm going to stay in. And yesterday when they blocked everything, we couldn't buy anything, and then people started to panic sell, you know, like, and then it started to drop, and then I decided to set a stop loss. I was like, okay, I'm gonna exit with 100% return, but when they hold, because they start to hold everything, they basically they sold my shares without hitting my stop loss. Can you believe it? I was really annoyed. And then obviously I contacted my broker, you know, the platform that I use. And then I said, oh, your stop loss was hitting during the hold. And I was like, no, it isn't, because you sold my share like a whole dollar above my stop loss. So how can that be hitted?
So if you want
Because
to know why there is an imperfection of stop losses. Stop losses, they work great with ETFs, exchange traded funds, because you don't have what is called gap ups or gap downs. What a gap down is some type of news to happen either pre-market, after hours trading, or in this situation when they stop trading. So if the stock, well, let's say it was at 25 bucks a share, and your stop loss was at 22.50, and they halted trading because of all this crazy news that's been going on. When they resume trading, and let's say it resumes at 18 bucks a share, your stop loss will be executed at the very next tick past the price that you put that at. So I can't remember what example, like 22.50. So the next tick past that. So if after hours trading or when it was halted, it goes well below 22.50, and that's the next tick as soon as it opens, that's where your stop loss is going to be. In one of the courses I talk about, different types of market orders, sell orders, limit orders, and I talk about stop losses and how it could be good, but there is a risk. And that risk is, once the market closes and before it opens up again, if there's a gap down, you can really get executed a price that's unfavorable, like what you just said.
yeah, but the thing is, they sold above my stop loss. So, for example, my stop loss was I think 850. They sold my share at 950.
Oh,
and
really?
then, yeah, they sold above my stop loss. So that's why I don't understand. Because so basically, it didn't came down to my stop loss. So when then they said, oh, it came down during the hold because they halted, and then because to stop everything, because they trying to manage the obviously, the volume, how many, people are buying, selling. And then I said, oh, because it got heated during the hold. And I was like, no, it didn't, because you sold my shares at a whole dollar above my stop loss.
Yeah.
So because my stop loss was just to make sure I take the profit that I wanted, because I want to stay in the trade just to see what's gonna happen. Because what if would go crazy like GME is going crazy now? So I would be pretty happy. So I just want to stay in. But obviously, if it were to come down crashing, I would come out with a profit, with 100% profit. So that's where I set my stop loss. But no, they sold my shares a whole dollar above my stop loss. That's just like, I don't know. It happened like to many people apparently. Robinhood, they did the same as well to many traders. Everyone that had stop loss set, it pretty much all of them got sold, because what is happening is the hedge funds, they are trying to get out of their position, but if there is no shares, they can't buy back. So So obviously this company, they want to help, this big hedge fund because they are losing billions.
You
So
know what I
obviously,
read yesterday, Lemore, and it's a total conflict of interest if it's true. But Citadel, the huge hedge fund, they own Melvin Capital, the one who created the short with GameStop. Citadel accounts for 40% of Robinhood's revenue. So tell me that's not a conflict of interest right there. Yeah, now we know why Robinhood shut us down to help out their biggest customer.
Yeah.
Yeah, one of the congressmen, I can't remember who it is, but he wrote a letter yesterday looking into why Robinhood did this, and there better be some action taken as a result of it. So we'll see. I think it's a rigged system. I think that obviously the big money on Wall Street is in Robinhood's pockets and TD Ameritrade's pockets, and it's just one more way they're going to screw us. But going forward, as I said, these investors who are buying GameStop didn't do anything illegal, didn't do anything shady. They just did what they are allowed to do. And Wall Street didn't like it. So they're crying like the rich crybabies they are.
Yeah, of course they are.
Yeah.
They can do it to us. Look at what they did in 2008. Like they broke the country and no one got accounted for.
Nobody did. We had to pay for their mistake. The taxpayers did.
Yeah, we got paid for their mistake, and now like just because we are trying to get back at them, play their own game, they decide that it's not right. They they were mooning on CBN and all this, like going live everywhere and complaining, and they did shut down the Discord group because I cannot access it, but the Reddit is still open, and they shut down.
They shut them down for a while. They shut Wall Street Bets down.
On Reddit.
Yeah.
On Discord, I know that they did. On Reddit, I was still able to see it, but I think they couldn't post anything. But on Facebook, that is all gone. They closed,
I know. I was looking for it yesterday.
Hi, everybody.
Hello.
So, what's up? Oh, thanks. Getting a massage now.
Yeah. But it's crazy. I can't believe what they're doing. Like, seriously, like, even like, I was like, why am I not allowed to buy what I want? It's my money. I'm spending my money. I'm not lending money. I'm not buying on margin. Like I wouldn't understand if it was like margin, or you're trading option or doing like naked call and all these things, like then I would understand. But it's my money. I decide if I want to lose it or not,
Yeah.
So
I wouldn't be surprised there's a class action suit over this. But
they
on the other
filed
side of that,
against the Robinhood.
When you lose money, the taxpayers pay for your mistake, and if you're not getting your way, you just cry, and you have all the power to shut down Robinhood.
Sounds fun.
Pisses me off. All right.
I like shutting stores down.
All right, cool, JJ.
Yeah, but one of the guys from the group, he was on Wednesday, he was up $47 million because he bought coal. So he's managed 50,000 share of GME because he bought like coals. So he only spent like a 14,000, and he's on like 47 million now.
Yeah,
crazy.
It's crazy, and that's one of the trading strategies I'm going to cover today. Because it's pretty cool what can happen if you're buying the calls, but you're doing it the right way. Because buying call options does have a ton of risk. And I'll go over the trading strategy that we did last week with CVS, and then I'll show you, what these guys on Reddit did, how they made their money, and how we can do it also, as long as we understand the risk and you follow the rules to make sure that we don't get hurt.
Yeah.
So Candace, Rod, what's up, everyone? I was telling Loudmore before you guys hopped on. Yeah, in the Trade Room Live group yesterday, I said we were going to talk about NXST today and go through that analysis. But shortly after I sent that message, I kind of had a change of heart there, because with everything that's been going on with GameStop and AMC and everything, I thought this would be a perfect time to talk about that. Explain what happened, explain, what these shorts and short squeezes are, and how we can use opportunities like that to profit from it, and how we can find those opportunities. And then a couple of new trading strategies that you haven't learned yet. So that's what we're going to cover today.
Okay, well, thank you for that update because I got started on it. I think I was almost done. I was going to ask you some questions about it, but now that I'm not complete with the next star, I feel better because I guess you're going to do that next week.
We'll do
I
that next week. Yeah,
Okay,
Candace.
good. So I can just finish up and then we can see what we both feel about it. So
Okay.
okay, perfect.
I was doing the analysis this week. So did you have any questions for me right now, or do you just want to wait till next week?
Yeah, we'll just wait. Just
Okay.
wait. Yeah.
All right. Cool.
Hopefully you cover the risk involved too,
In with the
with what you're going to talk about today, Tom.
oh, absolutely. Yeah, you have to cover that. That's the most important. You can blow yourself up if you do it the
With-
wrong way.
Yeah, with what happened this week, especially.
hmm Yeah, I've never seen like every form of media was covering this thing, like mainstream media, obviously the cable channels, everywhere on social media and Yahoo. It's just everywhere you went. Like my wife, who has absolutely zero interest in stocks, is asking me, what's shorts and what's Wall Street bets and this and that. My sister's texting me about it. Yeah. So people who don't have any clue are their interest has definitely been peaked this week. So let's get started. It's not going to be too long. It's probably going to be less than an hour today, but I think what we're going over is pretty awesome. All right, Raph just joined us. What's up, Raph? All right. So once again, this is something I just
Hi guys, how are you?
Hey, so you know this by now. I'm not your financial advisor, so I'm not here to give you specific investment advice or recommendations. I'm teaching you how to do this so you can make those decisions on your own. So this is what we're covering today. Real briefly, want to recap the CVS trade that we did last week and show you how it's working out so far. And then we're just going to talk about what happened this week. What's a short sell? I put on here slow slides because in one of my courses, I believe it's my investor or the stock market for beginners course. We go over this briefly. Show you, what a short squeeze is, how that worked, and how what happened this week with GameStop. A couple option trades to take advantage of situations like that, as long as you follow the trading rules. So, Rod, that answers your question. Are we going to talk about the risk associated with it and how to make sure that we're not going to get hurt? Long call, that's the one strategy that a lot of the people, and Lattimore, the example you just gave where the person made $44 million, that was a trade that he did. And then we're going to do a back test example. So one of the cool things with Thinkorswim, as you're learning new trading strategies or investment strategies, you can use their tool called ThinkBack and go back in time and see how this trade would have worked out. Because every piece of data that's happened in the stock market, every tick up or down for every stock, every option, they have records of that going back 10 years, I think it is, but don't quote me on the exact time period. So we can go back and see, all right, if I place this GameStop call option, if I bought it today, how did that look going one day into the future, a week into the future, and then we are going to do that trade for Nexstar. So we'll get into that. So first off, this is what we did last week. Does anybody have any questions with how to set up a bull put spread? We have a small group, so take your mics off of mute and just chime in if you have any questions.
If I just remember, I'm not too sure if it's this one, but it's you. You sell a put. Let's say let's say the stock price is at 50.
Mm-hmm.
You sell a put at 40, and you buy a put at $30. Is that one? Is it that one?
Exactly. Yeah. So you're selling the short put below the price of the stock, and even further away is the long put. That's correct, Raph. Okay. And then this is the trade that we did last week. So CVS at the time was trading at 74.08. When we analyzed them doing the fundamental analysis, we came up with a target price of $85 a share. So what we did is we sold the 65 put at 26, and that's going to expire in February. We bought this $60 put for 6 cents, which gave us a net credit of 20 cents. And to determine the risk and return. So the total money at risk, that would equal the spread. So if you come back here, We did a 65 and a $60 a trade, so that's a 5-point spread. So the total money at risk is that $5 minus the premium we collected, which was 20 cents. So the maximum risk is $480 for one contract. That's the most that we can lose. And the rate of return is the premium of 20 cents divided by that money at risk. The 20 cents divided by 480 is 4.2%. So again, it doesn't seem like a lot, but this is a trade that's less than 30 days. We are risking a lot though. And this is the one question I get from a lot of people who are new to options trading and they see the strategy, or a good friend of mine always says this is the dumbest trade ever because he likes doing the buying of options. Why are we risking $480 to make 20 cents? The odds are so heavily in our favor. That's why we do this trade. We're going to make a positive rate of return so many more times before we ever have a loss. So with this trade right here, if CVS goes up, we have a winning trade. If they trade flat, we have a winning trade. And if CVS falls, but not too far, we still win. So what other investment strategy can you make an annualized rate of return of 52.8% and you don't even have to be right? So how did I come up with 52.83 for those of you who are joining the call for the first time? Our rate of return, when we go back a slide, is the premium we collected of 20 cents divided by $4.80. So
Sorry,
yeah.
Just a quick question. The money at risk, when you say $4.80, is it for one share or for the entire contract? For the entire contract, you have to multiply this by 100, right?
Correct. Yeah. So that's per share, and one contract represents 100 shares. So it's $480 for the entire contract.
You can lose if you do the things right.
Yes.
If it goes to the wrong direction. Okay.
Yes. And let me go back one more slide. So if you see up here, the stock's trading at 74. So if this trade does go against us, the stock can go from 74 all the way down to 65 before we have a loser. So if the stock trades flat at 74, we win. If it goes all the way up, of course we win. And if it goes down but not too far, we still win.
Okay.
So we make money in 3 different directions. And hang on, Raf. So getting back to this right here, 4.2%. We were in the trade for 29 days. So the annualized rate of return is what we do is we divide 365 days in a year divided by the total days that we were in that trade, which is 29. So there are 12 and a half 29-day time periods in a year. So 12 and a half times our rate of return means if we do this trade every single month, we can be right around this area, 52, 53%. So again, the trade where we can be right in 3 directions, we can be wrong, and we're still making a 50% rate of return. Not too bad. Raf, what were you about to say?
Yeah, just a quick thing. If we haven't put did the buy the if we didn't buy the put, the loss will be higher than 480, right?
Yeah, because at that point, the stock can fall from 74 where it is right now all the way down to 0. So if we come back here, stock's at 74. We're protected from the stock going from 74 down to 0, or from 60 down to 0. So this not only does this limit the losses, but it also makes the trade much cheaper, because you come right here, the spread minus the premium, this is the total money at risk. But if we don't have this trade, we would have to have $65 times 100. We'd have to have $6,500 in our account to cover this trade, because if the stock falls from 74 down to 65, if it's just a short put, we are obligating ourselves to buy CVS at 65. So we have to have enough money in the account to buy 100 shares of CVS at 65. So now we're looking at $6,500 in the account to buy this one stock versus just 480 to put on the spread.
Okay.
All right. All right. So that is this the trade we did last week. One person hopping in, and let me show you this chart right here. So what I did, I drew here where our short put is. So as long as CVS stays above here, we're all good. We don't need to worry. And so far, we did the trade a week ago. Everything's looking pretty good. It had a nice little run up, and then it's trading kind of, a little flat, came down a little bit. But we are still very far away from that short strike price. So right now, the trade's working out pretty good, and we're making money. So I like this trade. So now we're going to start talking about GameStop. But actually, before I do get started, any other questions about the credit spread? You guys understand it pretty well now? Okay. All right, so let's hop into this then. So short selling, this is what created all the news this week. So if you're unfamiliar with what that means, short selling is when you are predicting the stock will go down in value. And here's how it works. Here's how you put the trade on. So to sell short, you need to borrow shares from your brokerage firm. And these borrowed shares, since you're borrowing them, they have to get returned at some point. And if you borrow shares that you don't own, we got to give them back to the brokerage firm. And let's just assume that we borrowed shares at $50. And we did that because we think it's going to go down. Maybe it's going to go down to 40 or 30, or in the case with GameStop, they thought that stock was going to go down to $20 a share. In this example, we borrowed shares at 50. And if it does go down to $40 a share, we need to now go back and buy their shares. So we borrowed them up here at 50. Now we have to go buy the shares to give back to the brokerage firm. And if we're able to buy them at a lower price, this example, $40, that $10 difference is our gain. So pretty straightforward. But what if the stock doesn't fall? And that is what happened this week. When you're short selling, the maximum return is if the underlying stock falls from where it is right now, in this example, $50 a share down to zero. But your risk is unlimited. Theoretically, a stock can go to the moon. So the people who were shorting GameStop thought the stock was going to go down to 20, and it went up to several $100s a share this week. They had a lot of risk. And if the stock does go that high, we would have lost a lot of money. Because of this huge risk, short sellers are forced to buy shares to cover their position and limit their losses. And I say they're forced to do so because the brokerage firm where you borrow those shares from, they are going to make you cover your position. So even if you think that the stock is still going to go down, you don't have the luxury to just sit and ride it out and then wait for it to correct. You have to cover your position and buy the shares. So this is what's been going on. If the stock starts to go the wrong way, if you are a short seller, that means the stock is going up. They have to cover their position by buying shares. And that means that the stock is being bought by even more investors. So when even more buying occurs, what do you think happens to the stock price? This, look at that. That's GameStop over the last couple of weeks. That's crazy. And unless you've been living, under a rock, I'm sure you're familiar with this now. So what happened was the hedge fund managers were betting it's going down, and the geeks on the Reddit group Wall Street Bet said, "No way! We're going to band together. We're going to make this thing go up," which it did, and it caused Melvin Capital to lose billions of dollars on this trade. So the average folks like us beat the pros at their own game. So that part is pretty cool. What is not cool is what Loudmar and I were talking about before most of you hopped on here. Robinhood shut buying down yesterday. TD Ameritrade halted trading for GameStop. Webull, what was the other? I think it was Interactive Brokers, but I'm not 100% sure. So all these major brokerage firms where people go to buy and sell shares, they halted trading on the stock. Why? I have no idea. At Loudmar, as you said, we weren't using margin. We were using our own capital. And so basically, Wall Street got pissed off that we beat them at their own game, and they cried about it, and Robinhood shut down trading. And in my opinion, I think what they did was illegal. And I found out last night that Citadel, which is one of the largest hedge funds in the world, they own Melvin Capital, the firm that went the wrong way and lost billions of dollars. And interesting enough, let me let this person in here. and again, I didn't fact check this, but where I read it was a good source, that Citadel represents for 40% of Robinhood's capital, of Robinhood's revenue. So that sounds like a conflict of interest, doesn't it? So these billionaires are losing money. They're crying about it because we beat them at their own game. So it's going to be interesting to see what happens going forward, because Loudmar, as we were talking about, nothing bad happened, nothing illegal happened. If someone wants to bet that the stock is going down, and just because they're the professionals on Wall Street, does not mean that we can't buy the stock. And that's what happened. People were on Wall Street bets saying, we're going to buy the stock. We banded together. We bought it. Stock went up. The short sellers had to cover their short position to buy it. That's the short squeeze. And when they added more money into the stock, it started coming all the way back up even further. So what happened was crazy. This is not unusual, though. This has been going on for decades. The only difference is that the Wall Street players play this game among themselves. Never before has the Wall Street guys gone one way and all of us average folk go the opposite way and win. So what happened has been happening since the beginning of time. Nothing illegal happened. So hopefully, what happened with Wall Street bets, that's going to continue going forward. All right, so my favorite trading strategy is to be a seller of options. So I want to show you how to play the next squeeze. And as you saw in that CVS trade, the odds are so much more heavily in our favor that it doesn't make sense not doing that option selling strategy. However, there are a few specific times where I will be a buyer of options. And at times like a short squeeze, you can make an absolute killing. We talked about that one guy who made $44 million off of Gamestop. Loudmore, how much did you say he put in? Was it 14,000?
Yeah, only 14,000.
Okay, so he turned 14,000 into $44 million.
Wow.
Not bad, not bad. So before I get into the rules of the trade, you need to understand this when it comes to buying of options. And then for those of you who are joining us for the first time, if you hopped in late, I'm recording this session. So if you want to catch the beginning, just shoot me an email and I'd be happy to send you the recordings. My email address is tom@wallstreetvalue.com. And again, for those who are hopping on for the first time, we talked about a couple different option trading strategies over the last couple weeks where we make a little bit of profit consistently, time and time again, whether the stock goes up, down, or even if we're wrong, or if the stock goes up, if it trades flat, or even if we're wrong and the stock goes down, we can still make a profit. So we're making small profits, we're hitting singles, maybe even doubles consistently, time and time again. That's the main trade that I like to do just because I win so much more frequently. But here we're talking about the other type of trade. We're going to be a buyer of options. So again, before I get into the rules, here's what you need to understand. When you are buying an option, you need to be correct in the direction in which it moves, but you also need to be correct in the time frame in which it makes that move. And if you're wrong on either one of these, you can have a loser. So therefore, it's absolutely imperative that you follow the rules if you are going to be a buyer of options. And here are the trading rules. You want to write this down or take a screenshot. First, we got to identify the current trend of the security. There's a phrase that we all use when doing short-term trading, and that is the trend is your friend. No need to swim against the tide, so trade with the trend. That's obvious. Next, go on a charting system like Thinkorswim or stock charts and draw the support and resistance lines on your chart. So you can see where you think the stock could go based on that current trend. And then most important, trading volume. This must be surging above the average daily trading volume. And when I get into the example here, I'll show you what that looks like. So when I'm going to do this trade, I'm only going to buy an option if volume is surging. Then there's a couple short-term indicators that I like to use. I use the relative strength indicator. I use the Williams %R indicator. I use the MACD, which is a more well-known stochastics, and a moving average. And I put these on my chart, which I'm about to show you. And when we see a volume spike, and we see 3 or 4 of these indicators turn positive, some people put arrows on the charts. When you get a green arrow, when you get those indicators turn bullish, at the same exact time or within a short period of time, along with a volume spike. And then when implied volatility is lower than historical volatility, that can be a home run. This, when all of these line up, I'll be a buyer of options, but this is the only time I will ever be a buyer of options, when these things all line up right here. So again, we're looking for the trend, but then we want to make sure there's volume, significant more volume than average. The arrows tell us it's safe to get in, and implied volatility is lower than historical volatility. So I'm going to ask you a question. I'm going to quiz you from what we learned last week. Why is the last point important? Implied volatility should be lower than historical volatility. Does anybody remember?
Yeah, because the premium will be high to pay because we're in the other direction. So if when you sell off option, you want it to be, you want the implied volatility to be higher because you'll be paid higher premium. But if you're a buyer, you want it to be low
Exactly.
so that you don't pay higher premium.
Yes. So when implied volatility is lower, that means option prices are cheap. And when they're cheap, we want to buy cheap options. If we're selling, we want implied volatility to be higher because we want to collect higher premiums. So that's exactly right, Raph. So this right here, when implied volatility is lower, this means that we're able to buy this option at a cheaper price. It's not going to cost as much. So to play the short squeeze, here are a couple terms you should be familiar with. What is float and what is short float? So float is basically the total number of shares that are available for trading in the marketplace. And in the short float, this is the percentage of those shares that are being sold short in relation to those available shares. So in reality, a company could have 100% of its float being sold short, but that's very unlikely, very unusual. What we want to see is that it's over 30%. Even when we see short float greater than 50%, that's unusual. When we do see float greater than 50%, we should pay attention to that because that is a candidate for a short squeeze. So sounds cool and all that, but where do we find this? Let me show you a tool that I haven't introduced to you guys yet, but it's really valuable. This is called FinViz. Now you can get some stuff on here for free. They do have a membership. And what I'm about to show you is part of their free service. The only thing that sucks about this website is all these stupid ads that keep popping up under the free version. So let's go to the homepage. I'll show you this from scratch, how we find this. And as usual, it's freezing up. Okay. So we're going to go right here. We're going to go to screener. Click on that. Over here where it says float shorts, we're going to scroll down to where it says over 30%. And then we're going to click on ownership. Come on. These damn ads. Now, let me go back. It might be worth buying it just so you don't have these ads popping up every 2 seconds. So let's try this again. We're going to click on ownership. And then right here, you'll see float short. So if you click on this, it'll show you which ones have the most. Look at that. GameStop is still pretty crazy right there, 122%. And then you have these right here. The top 10, these all look like potential short squeeze candidates. So if you are interested in trading something similar to GameStop, maybe make the next 44 million for yourselves, this is how you find some candidates to do that. All right. Let me go back to the slides here.
I was just looking at that, Tom. That looks pretty good. I think monthly it's only like $24.95 or something. So
it's reasonable. Yeah, it's not bad at all. That's if you pay for the whole year up front. If you pay for just as you go monthly, I think it's like $34.
okay.
Yeah, but it's reasonable.
I like that where they have the 10 most active, the highs and the lows there.
There's a lot of good screeners on there. I used to have the premium version. I'm probably going to subscribe to that again because it is so cheap. All right, so let me give you guys two ideas to walk away with, and then I'm going to back test you this trade on Nexstar and show you how huge it was. And that example wasn't even a short squeeze. It was just those indicators all lining up at the same time, and we made a triple-digit return. So I'll show you that. But the two types of trades that we can use to profit from this type of scenario is a debit spread and also a long call. So let's do the debit spread, the debit spread first. It's kind of similar to what you've learned already, but instead of being paid a premium, we're paying a premium. And because we're paying money, we have more upside potential. So a trader is going to place a debit spread to have more upside potential than a credit spread, like that CVS example, but less time decay risk, and it's also more cost effective than just buying a long call. And do you guys remember what time decay is? If not, let me know. Just say aye.
Yeah, I remember.
You do remember? Okay. All right, so I'll just assume that you guys are cool with that then. So here's the benefit of this trade. As I just mentioned, it's more upside. And in this example right here, you're risking 75 cents to make 4.25. Since you're also selling a call above the current price of the stock, you're minimizing or even eliminating time decay, since time decay works in our favor as an option seller. So we're buying this right here, we're paying $2, but we're also selling a call. So this here, the time decay is working in our favor, which negates this trade right here where it's working against us. All right. So where was I? Okay, so another benefit to this trade is that it's cheaper. Since you're selling a call, that's going to help pay for much of the cost of the trade. So if we're just buying the call, it's going to cost us $200. So $2 per share times 100 shares equals one contract. So it would have cost $200 to place this trade versus 75 cents or $75 for a whole contract using the debit spread. The only downside is that your upside is capped at $4.25. That's the most you can make, but it's still a very nice profit potential. In a short squeeze scenario, like we saw with GameStop, you would have left a lot of money on the table by doing this trade. But again, you're still making one heck of a return. So debit spread consists of buying a call. And when I do these trades, the long call option that I select is usually at the money. And then we're going to sell a call above the current price of the stock. So right here, the stock is at 50. So we're going to buy the $50 call and sell the $55 call to create that $5 spread. And since we're paying for this trade out of pocket, the stock needs to go up by at least 75 cents to break even. And if the stock rises to 55 or higher, then we would have made our maximum profit. So pretty straightforward. And since you guys have learned what the credit spread is, this is just a variation of that. And then here is what a lot of amateurs do, and they get crushed. But you also have a lot of people on, like the guys on that Reddit forum, that know what they're doing, and they made a fortune just buying a long call option. So buying a call option. Remember last week and a few weeks ago, I showed you that chart that had the 4 scenarios. Someone tell me, Raph, I know you know what this is, so I'm going to ask somebody else. Tell me what a long call is. What happens? What is the primary goal when buying a long call? Any volunteers?
You're expecting the price to reach a certain area or target.
Yes,
So
is that expected
if it's
price
traded,
higher or
yeah,
lower?
Yeah, if it's traded at $2 now and you buy a long call, I don't know.
Are you expecting? Go ahead.
Go ahead, Lamar.
So yeah, basically we're expecting the price to increase.
Correct. And when it's a long call, not a short call, are we buying or selling? The long is another word for being a what? A buyer or seller?
We are buying, no?
Correct. Yes. The long call. So as a long call option, we're buying. We're purchasing a contract, and we have the right, but not the obligation, to buy shares of stock at a specific price, which is the strike price, anytime between today and a future expiration date.
Because we said these are the stocks that we actually want, right?
Correct.
Okay.
Sort of. You actually, and I'm going to show you what I mean by sort of. You don't have to buy the shares, Candace. You can actually just trade the premiums.
Right. Okay. Gotcha.
Okay. But yeah, a lot of people do this because they do want to buy the stock. So let's say, for example, I want to buy stock right now. It's at $50, but I don't want to fork over thousands of dollars to buy the stock. I only want to do so if the stock is at, say, 60 by expiration date. So if that $50 stock goes to 60 and I have a $50 strike price, I now have the right to buy that $60 stock for $50 anytime between now and expiration date. All right, so again, Latimer, you answered this question. If you think the stock's going to rise, you can control 100 shares of stock by purchasing a long call contract. So the benefit here is that it is cheaper than buying 100 shares of stock. And if the stock does move in that right direction, the rate of return will also be significantly higher than if you were to just purchase the shares outright. And I'll show you that in a moment as well.
Tom, do you have to be at a level 2 with your brokerage firm for this one?
Yes. Yeah.
Okay.
Yeah. Level 2 or 3. I forget which one it is. Level 1 is just selling covered calls and protective puts. So good question. The downside, the odds are against you, and they're not just against you by a little bit. The odds are against you by a whole lot, because there have been stats, and every year the numbers change a little bit. But on average, 90% of option contracts expire worthless. What that means is, if you are buying an option, 90% of the time that option's going in the wrong direction that you want it to go, and you will lose 90% of the time. So this is not what we want to happen if we're a buyer. It's very enticing if we're going to be a seller of options. If we're selling options, we want the option to expire. That means it didn't get to the strike price where we were either forced to sell shares or forced in a covered call, or forced to buy shares in a naked put. So again, why are the odds against us so much? Because we have to be right in the direction, and then it's also we have to be right in the direction in which it moves in the short term. And it's hard to predict both of those. So if you select another way that this can not work against you, but another thing that makes this tough, when you select an expiration date, if you select an expiration date that is short term, the trade's got to be cheaper, because part of the option premium that we're buying, part of that premium consists of time value. So longer term options, we have more time, it's going to cost more money. Shorter terms, got to be cheaper. So a lot of people, especially beginners, they buy calls because it's cheaper than buying 100 shares of stock, and they'll select a strike price. It's just the current month, or maybe even 1 month further out. It's got to be cheaper. But if you don't allow yourself enough time, then time decay starts to eat away at your profits, if there are any profits. Or what usually happens is you didn't allow yourself enough time for your prediction to be correct. But then the other thing is, if you select an option date that's too far into the future, it's going to cost a lot more to buy that option. And that might eat into your profits, if you have any. So what I'm saying here is not meant to scare you away from buying options or to discourage you. I'm just being real with you, and I want you to know what you're up against, and so you can set realistic expectations. To minimize these risks, you must follow the rules to a T. Don't stray from them. Don't start off using these rules, and then after 1 or 2 winners, you make your own rules. That doesn't work. So this is going to help you out significantly if you follow the rules that I set in place for you. But that being said, let's use a think back tool in Thinkorswim and see how a trade like this could have worked out if we follow the rules. So the first example wasn't a short squeeze, but it's an example of all these rules coming together for the stock that I was originally going to analyze today. And that's Nexstar Media Group, and the ticker is NXST. And we'll analyze them next week. So as you can see right here where I circled, this line is known as the 10-day moving average. And when the stock price closes above that moving average, that is a short-term bullish signal. So right here, we got a bullish signal. Right here, we see, and I circled right here because you have two things happening at the same time. Number one is the stock closed above the 10-day moving average, which is what we want to see if we're bullish. And then you have this volume surge. You have a ton of volume happening right here. Then if you come down, this is the stochastics. So it closed above the 20 line. So when it comes down below 20, it becomes to a point where it's oversold. And when something's oversold, then people are going to start buying it. And so it closed above this 20 line, which means it is now turning into a upward trend. So this happened right around the same time, just a day or two before you saw the volume peak and close above the moving average line. Down here is stochastics. This happened also maybe a couple days later. And then this is the Williams %R indicator. So this went positive right here. So it closed above that 80 line and started to go up. So this indicator, this one right here, plus the moving average, plus the volume, all happen at the same time. And when these things line up perfectly like that, good things can happen. But let me show you this right here. I'm going to use Think Back in a minute, but I want to show you how the trade, how we set up the trade. So actually, let me go back real quick. This volume spike happened right around November 9th. Okay, so let's go back into Thinkorswim. Let me share my screen, different screen. All right, so this is Thinkorswim. And if you want to use Think Back, so you come here where it says Analyze, and then over here is Think Back. So what I did was I typed in the ticker symbol for Nexstar, NXST, and I went to that date where we saw the volume spike, as well as the indicators all turning positive at the same time. That was right around November 9th, and you see that right here. Actually, hold on. Can you see that? Or is my ugly face covering this up?
We can just we can see it there, Tom, but it's just right at the top of the faces.
Yeah, so if your little images there are covering it, just move it on your computer so you can see what I'm looking at. So that's the date that we went back in time to, November 9th, 2020. Type the ticker symbol right here, and over to the left, we're looking at call options. And what we want to do, since the price of the stock that day was $90.38, I want to buy the at the money call. So here is the strike price, $90, and I went out 2 months, to January 15th, 2021. If I selected this option, it is going to cost me $6.65 to control 100 shares of Nexstar, and it's going to allow me to buy that stock at $90 anytime between now and January 15th, 2021. Are you guys with me so far? All right, so let's go forward 7 days into the future. Again, remember, we had a volume spike. We had the Williams %R turn positive, the MACD, the stochastics, and the moving average. The one indicator that's not on here is the relative strength, but that turned positive at the same time too. So everything lined up the way we wanted to. We bought this right here, $6.65. Because we bought this option, doesn't mean that we have to hold on to it until expiration date, which is in January, this January. We can sell this thing anytime that we want to. So Candace, to answer your question, there's two things that we can do. We can buy this call option for the right to buy $100 or $110 stock for $90, or we can do this. Let's go 7 days into the future. 1, 2, 3, 4, 5, 6, 7. Remember, we bought it for $6.65. 1 week later, we can sell that thing for 17 bucks. But we don't have to buy the option, or excuse me, buy the stock at 90 between now and expiration. We can just trade the actual option itself. We bought it for $6.65. 1 week later, it's at 17 bucks. Now let's just go one more week into the future. calendar. Come on. All right, so I think your swim is freezing up. Fortunately, I don't need bigger swim to do this. Give me a second. I'm going to share my other screen with you. There we go. This is what happened. So 2 weeks later, that $6.65 call option went to $18.90. Because everything lined up the way we wanted to. 1 week later, we made 155% rate of return in just 1 week. Now, if you bought the stock, if you exercise the option to buy this $104 stock for 90 bucks, you still did pretty good. You made 16% on that stock. If you decided to wait 2 weeks, you held on to that contract for 1 extra week, the option premium went up from $17 to $18.90. So in 2 weeks, you made 184%. Now the stock, if you wanted to buy the stock, you made 19.25. So that is the returns you can expect if you follow the rules and you wait for everything to line up perfectly. Now, this was not the short squeeze. This is just a stock that had a lot of volume, and then those indicators lined up the way we wanted to. Let me go back. I'm going to see if I'm going to see if I can get Thinkorswim to work again. Oh, there we go. Now let's take a look at GameStop. There we go. It's right down here. All right. Actually, I'm going to look at the chart first. And it had plenty of volume here. Okay, so let me look at one more thing. While I'm looking up my, I'm going to try to find the chart to show you guys. Any questions with this yet? You guys are quiet today. There we go. All right, so what we see here, right around the 11th of January, we see the original spike. That's a huge spike, volume spike compared to everything else that we've seen going all the way back over a year. You got the spike right there. It traded above that moving average line right here, and it's continued to be above that moving average line. So we got a good signal well before that volume spike. So it's still in the green territory. You got the arrows turning green right here. The only thing that did not happen is that we got a buy signal right here, but then you had a couple sell signals. So this is a conflicting signal. But if you remember what I said when I started off with the technical analysis, we want to see 3 of the 4, or if you're using relative strength, we want to see 4 of the 5 indicators turning positive. And so this one did not turn positive, but so far you have stochastics. Where's the MACD at? MACD is giving us a weird signal. It didn't line up perfectly, but you saw this volume spike right here. And again, this happened on January 11th. So let me go back to Thinkorswim. And we're going to do, where's analyze? All right, think back. January 11th. I guess we're not going to look at this one. Thinkorswim or TD Ameritrade is one of the companies that shut down trading. But it looks like they halted their data too. I'm good at Yahoo. We're going to go to Yahoo Finance. My computer knows it's Friday and it's already in weekend mode and is running slow. All right, and we're going to look at, hey, look what the top story is. Surprise, huh? All right, GME. Gamestop. All right, now let's go to options. Oh, crap, you know what? Excuse me. Yeah, this isn't going to give us the historical price. Shoot. Well, if you guys want to goof around with Thinkorswim, go to Analyze, go to Think Back, look to see something like that set up with Nexstar, and you can see how that trade is panned out over time. So that's buying a long call. So if you remember, I usually do sellers. I usually do option selling strategies. I'm only going to be a buyer of option when those trading rules tell me that everything is lined up perfectly. And when it does, we can see those triple-digit rates of return in a very short amount of time. So,
Tom, on this Thinkorswim, where it says instrument GME has no options, does that mean they've canceled the option buying and selling on that or not?
well, this is
Right there where it says,
yeah, right there. This is as of January 11th. Let's see. You know what? Let me type in a different company.
I was thinking about what happened this week and that too, but
You know, that it would have halted it for future trading, but we're going back before this happened.
right.
All right, so Disney, there's the option chain for Disney. So let me go back. Hopefully it'll refresh. Ah, there we go. Okay. Looks like we're good. I don't know what the problem was. Just had to refresh. So we're using Think Back. We are looking at the options on GameStop on January 11th, and let's take a look at the money strike price. So the stock was $20 a share. So what was the $20 strike price to buy that call option? So the mark is usually right around the difference of the bid and the ask. So we would have paid $1.30. And that's, you know what? Now let me go to February, because we wouldn't buy an option that's going to expire just a week or so. Let's do this one. If we just bought the 1 month option, go to $20, and it would have cost $3.25 to buy GameStop $20 call options on January 11th. And now we just go forward in time and see how this is just exploding. The 2 days later, that option that we purchased for $3.25 could have sold it for $12.67. Next day, could have sold it for $20. Then it comes back down to 15. What's today's date, by the way? The right up here says a non-trading day, so January 15th was the weekend. So was, come on. There we go. Look at that. Now it's almost $20, 1975. Go another day into the future. Fell a little bit. And then here's where the option stopped on the 22nd. So go back to the 21st. How much did I say we paid for it? What did I say? $3.25?
Yes.
Yes.
3.25. All right. All right. So now it's at $22.90 divide or minus 3.25 equals divided by 3.25 equals times 100. That sound right? 605% rate of return. Not bad for a couple of weeks. So I know somebody just hopped on, and since you missed it, I'll give you the recording of this video. We showed you in the beginning of today's lesson what a short squeeze is, what selling short is, and how we can do a couple different option trading strategies to profit for or to profit on a trade like what we saw with GameStop. So that's it. So with Nexstar made 185% in 2 weeks, and right here due to the short squeeze, 600%. Obviously, those are not normal rates of return. That is why I use the selling strategies more often than not, because I could place those trades every single day. But once I find something that lines up the way that I look for it, that passes each item on that checklist, on my trading rules, that's when I'm going to buy an option and have those phenomenal returns. So that is it for today's lesson. We're right about at an hour. I'll stick around if you guys want to talk about this more, if you guys have any questions. For those of you who got to get going, I appreciate you chiming in here. And if you're not on our Facebook group, it's Trade Room Live. I'll be posting the recording here onto that Facebook group in the next day or so. Or if you don't want to join it and you still want the recording, you can shoot me an email, tom@wallstreetvalue.com. That is it. Thank you, guys.
Hear me?
This person back.
Can you hear me?
Yeah, I can hear you.
Yeah, I have a quick question. You know where to find the volatility if you don't have a line?
Hang on, what's that? I'm just somebody sent me a message in the chat, Raph. Let me just reply to them real quick. Give me 1 second. What's up, handsome?
Got like almost an hour of doing it with this house.
Good. You got to get your schoolwork done.
I don't care about school.
Yeah, better. All right, there we go. All right, Raph. Sorry about that. So where to find the implied volatility? Is that what you were saying? Did I lose you, Raph?
Daddy, if I have to do sports and I'm stealing your granola bars.
You can have them. I'm on diet now. I don't eat that stuff. Hey, Raph, you there, man? I guess not.
Did everybody see you?
Come on.
Where's my pajamas?
Oh, Loudmore, looks like you're the only one left on here.
Okay, yeah. That's it for me as well. I'm gonna go.
All right, have a good weekend.
Yeah, you too. I was just checking something. Yeah, Nikki, she couldn't be in today, but she said sorry, but she's gonna watch later.
Okay, yeah, hopefully she will be able to see this. Because, so what do you think? What do you think about this lesson?
Yeah, great. Yeah, absolutely. Yeah, I really liked it. And obviously, I'm very interested, to see how the guys were making money. So
Yeah,
I was very curious to see.
Also,
hey, well, if you get any ideas, let me know. I'll look into it.
Yeah, good. Yeah, and I didn't know you could look the float as well on Finzi because I used them, but yeah, I didn't know, so that was good to know. Yeah.
I think you can find it on Yahoo too, but I mean, it's pretty simple right here. Let me share my screen. Yeah, the only thing, as I was saying, You just got to fight with ads popping up every 5 seconds. But if that's
Yeah,
the biggest problem, then it's not too bad. So,
Not too good.
all right, guys. Well, I'm gonna log off.
Oh, sorry, I was disconnected. I had a problem of connection.
Oh, okay, there you are.
Yeah, yeah. Where do you find the where can I find the implied and historical volatility other than value line?
Value line. I know. I use Thinkorswim for that.
Okay, and other than Thinkorswim, do you have?
I don't know. This is the only one I use. I'm sure you can find it on any trading software. You should be able to find it on. Have you looked into interactive brokers? Is there?
I did, but it's not like very friendly user.
Okay.
Didn't think I saw any implied in historical volatility here.
It's a pretty basic drawing or study, if you want to call it that. Let me go to charts.com. I mean, that's more for stocks, not options, but they might have it. Or just, just Google. I found stock charts, but just Googling what's the top 10 technical analysis software programs.
Okay.
And this came up. So just Google, what's the best options trading analysis or something like that. And
another question I have is, I have two other very quick questions. The other one is, I took a quest trade and to try to buy some options here, but the orders are not filled. Is it normal in your technical analysis software? Is the same?
So you put a trade on for Quest and it didn't get filled. What type of trade was it?
For options. For stocks is it, but not for options. It's never filled.
Yeah, but what type of option was it, Raf? Did you do a
sell or put options?
You sold a put, okay. And when you put the trade in, did you set it as a market order or a limit order?
I did both. It doesn't work. I did market, it didn't go through. I did limit, and I put the limit of the strike price.
Okay.
And it
now,
did.
When you put the trade in, was it a paper trading account or was it real money?
No, paper trading account.
Okay, that I don't know. A lot of the time, well, if you do a market order, it should get filled immediately because you're just going to get whatever the market maker is going to give it to you. But if you do a limit, a lot of people put limit orders in and forget that's a limit, and they wonder why a day went by and didn't get executed. But if you put a market order in, actually, so what was? Let me look at something real quick, Raph. What was the name of the stock? It was Quest.
Quest Trade. Quest Trade.
What's the ticker symbol?
Oh no, Quest Trade. Sorry, is the software. Quest Trade is an analytical software.
Oh, okay. What stock were you trading?
Any stocks. Any stocks didn't work.
Really?
Yeah. But have you used ever paper trade where you're able to buy stocks like virtually and to see their evolutions?
Yeah, I used to. I don't do it anymore. I just use the real trades. But what we're looking at right here, no, you're looking at FinViz.
Because it's even I have a clear message telling me that in the training version, the orders are not actually filled for options. Okay. That sucks because I'm not able to train, like that.
Yeah, so you're getting that error message on Quest Trade, you said?
Yeah. It says, I'm not sure if it's error message. It just tells me the orders for options are not actually filled, in the training version.
Well, call them up and find out why they're not executed. I mean, it should still give you like a fictitious execution price just so you can trade it and see how it worked out.
Okay, well.
But as to why it's not, I don't know. That's something that you need to reach out to them. I've never used them, so I don't know what works or what doesn't.
Yeah. And another quick question I have is, when you buy options and you follow all the strict rules, do you reduce the 90% chance of or not even using all the 90% chance?
You're going in and out. Can you say that one more time, Raf?
Yeah. Any to lose when you buy a buyer option.
Mm-hmm.
So when you follow all the strict rules, do the 90% apply, or you reduce your chance to lose?
No, the 90% applies. That's when we're selling the options. So we have a different set of rules when we're buying options. So the probability OTM at 90% or better, that applies to selling. I don't know if that answers your question or not.
Because when you options, you have 90% chance of losing because you can go to the wrong direction, or or right.
Oh, yes, I see what you're saying. Yeah.
So when you follow this strict, the strict rules, do the 90% chance of losing still apply, even if you follow all the strict rules? Does it make sense?
I would say yes. No, it does make sense. I would say no. What is the probability? I don't know the exact probability of losing, but you're trading with a trend, and it's going in an immediate trend when all those things line up. That's why. That's the only time I ever buy options. I misunderstood your question originally, so I'm sorry about that. Yeah, but if I were to go buy, we're looking at Disney right here on Thinkorswim. If I were to just go buy a call right now because I wanted to buy Disney, just not at the price it's at currently, well, let me take a look at implied volatility. Well, first of all, the implied volatility is higher than historical. So right there, I'm setting the odds against me because I'm paying a lot more for it. On this screen that I'm looking at right now, it doesn't have stochastics or the other things. But if 2 of the 4 are positive, but the other 2 are negative, well, then that's not going to give me like a real clear trend. And if you look at where the trend is right now, it was going up, and now it's kind of reversing a little bit. So for the amateurs who just want to get involved with Disney without paying, what's the price at right now? $166 per share, they're going to buy the call option, but they're paying a higher price because implied volatility is higher than historical. It's actually higher by a pretty good margin. And then it's not in a clear uptrend. So they're putting odds against them right out of the gate. But when we line it up to where we're only going to buy it when there's the spike, and then there's other indicators are telling us that, yes, this is now going in an upward trend, obviously, because all 3 or all 4 of these are turning green at the same time, we're really putting so many odds in our favor.
Oh, okay.
Looking at exact percentages of having a winner versus a loser, that I don't know.
But basically reduce 90%. You'll say you reduce 90%. Okay.
By a lot, I would say, by a whole lot.
Okay. And by a lot, you think?
I think so.
Yeah. Okay. I shoot you an email just to ask you for this video in the video of the previous session, but you don't be more in the space in the website.
Hey, Rap, do me a favor. Call me because your connection's terrible. You keep going in and out.
Okay. Gotcha.
Give me a call so I can hear you better.
Okay, I'll call you. Wait.
Okay, I'll see you.
Okay, I'm signing off then, Tom.
Oh, you Ladmar, you're still there. All right, I'll see you next week.
Yeah, see you next week. Thank you for today. Yeah.
Oh, my
Another
pleasure.
great session.
Oh, thank you very much. Have a good weekend.
You too. Bye-bye.